a 10-minute discussion now on investment. It's something that came up at the last meeting about how people, how organisations are making the best out of this current situation, because we find ourselves in a very interesting period of time, probably like no other. So I'm delighted that we've got Trevor here from Eiduks, and his colleague Andrew is here as well, and I'm sure they'll be sort of responding. I've got some questions here that have been prepared for me, and Trevor, I think, will be ready to answer some of them, and his colleague Andrew as well. So first question I've got, and please, if anybody has any comments at the end of any of these questions, just dip in, and this is your platform as well, so you tackle these as well. But obviously Brexit negotiations and COVID have affected sterling for some time now. As we've resolved Brexit, finally, well, more or less, still got some problems at the borders, but as we've resolved it mostly, and hopefully during 2021, we'll be seeing the back of COVID, fingers crossed. What impact do you think, Trevor, this is going to have on sterling?
Okay, well, obviously, first, thank you so much indeed, Roger, and to LMF for the kind invitation. It's a pleasure to be here. Yes, so interesting times, goodness me. You know, Brexit was sort of, obviously, to a certain extent, could have gone either way. And it was very interesting before Brexit. We actually did a set of presentations around our clients and the city, et cetera, and the ones who voted for Brexit, we did a little poll at the end, were always the insurance boys, because of course it's the transatlantic, so it's the dollar that you're interested in. So now we have a trade deal, fantastic. So you know, Chicken Little, the world is not going to fall in, the sky's not going to fall in. But I think really from the Brexit, from the first sort of stories, yes, there are some teething troubles. You know, I think literally, you know, SME or the UK and SME businesses were given 7 days to understand the new Brexit trade deal, which obviously is not enough time. And that's why we're seeing issues with sort of, you know, cross-border goods coming across, and hauliers have decided as well really to take their time over things, and rather than have, you know, goods stuck at port, they're just not sending the lorries until they're really sure that they can get through, sort of thing. So I think we've got small sort of teething problems, and that's a negative for sterling. However, it's a big positive really that we do have this trade deal, so that's very important. And there's actually a house point. I'm going to give the government a house point for their approach to the vaccine. It's reported in the Times this morning that in actual fact, the reason why the UK has got such a sort of a leading position in the vaccination program is because they went to Pfizer, they went to AstraZeneca, and they said, listen, we want guaranteed supplies of vaccination or of vaccine, rather than sort of haggling too much about the price, etc. They said, listen, guarantee us. And that's why we've been, basically the UK is in pole position. If you look at Europe, if you look at the US and other developed nations, the UK is the one that's vaccinating its population, and that's really working, and that's a major factor for the markets at the moment. So that's why we're seeing sterling basically go higher. Now, the other point is, of course, that will change over time, but really there's this big sort of push as well from the US and from the interest rate scenario. So there used to be a situation whereby there would be a dollar premium. So US interest rates were 2.25, and UK interest rates were 1%. So you'd basically be turning around, if you held dollars, you'd make money over the year. You'd make 1%. Thank you very much indeed. So that goes into your coffers. I know you have the balance sheets where you have to have dollar denomination, so you'd be making money on that. Well, actually, insurance companies and people around the world, investment managers, etc., there's no premium to holding the dollar, and therefore, really, what we're also seeing, this whole sort of mismatch of Brexit supporting, to an extent, sterling, vaccination program, that's supporting sterling as well, and the interest rate scenario, that's supporting sterling as well. So in actual fact, we have got a trend, and if you look at the charts, we've got a trend higher in sterling dollar. Not so apparent in sterling euro, but certainly in sterling dollar, you have a trend higher for sterling dollar, and that may well continue Yeah, for sort of 3-6 months, if not longer. We'll have to see how the state sort of gets around this vaccination program, how Biden can come along and sort of, is he really going to be able to put masks on people? It's a real open question, whereas in the UK we're locked down and that's it, sort of thing. So yeah, it's interesting times, but positive backdrop.
Excellent. Thank you very much. Great insight.
Pleasure.
Great. Anybody got any comments, observations? Do chip in. This is an open platform.
Yes, please do.
Thank you. So the London market is very focused on the US dollar, and as a result receives a lot of US currency. We've obviously had a turbulent White House for the last 4 years with choppy policy from across the board. What impact will a more traditional presidency in the Biden administration have on the dollar, do you think, Trevor?
Well, first of all, I think I'll be able to sleep a little bit easier at night. Sort of presidency by tweet was quite interesting, but it did used to wake me up at times. So I think we're going to see some more stability, a return to normal politics, which actually means, you could see a sort of, we're seeing a little bit of support for the dollar in the very short term. However, Biden basically has this blue wave that I'm sure you've heard about. So they've got a very slight majority in the Senate. The Democrats, they have a majority in the House of Representatives, and they have obviously a Democrat presidency. So really, they can change pretty much, or to a certain extent, what they want. Now, Biden is someone who really looks for bipartisan support. So he's trying to get Republicans on side as well. But his basic idea is he's looking to spend and then to get some money back and tax. So that's what he's looking to do. Now, in that case, when you look at what's happening, as I said before, with interest rates, if Biden's looking to spend a load of money and his new Treasury Secretary, Janet Yellen, who was Fed chair before, she's happy with that as well. And the actual fact, last week, she said, listen, interest rates are so low, it's time for the US to act big and stimulate the economy even more. And when you consider that in actual fact, it costs the United States less money to service their debt now than it did 5-8 years ago when interest rates were high, 2.5% or higher, 3.5%, whatever it was. They're now basically, sometimes they can get sort of money given to them basically, and they don't have to pay an interest rate on them. The same as Germany does at times as well. So it's pretty cheap for them to service their debt. So in that case, what we are thinking, when you look at the technicals as well, dollar is in a 2 or 3 year cycle lower. So that's what we're suggesting. We're seeing that we can really see. We think this idea of spending, supporting the economy, making sure that when the vaccination program comes through, they can get to this herd immunity. This is going to take time, 6 months, 9 months, whatever. So they're going to have to support the market during that time, and they will spend money to do it. They've said they will. Now, interestingly, in the very short term, look out for Fed Chair Powell. He's talking tomorrow night at 7:30. And he'll be explaining to the market. The market did sort of think, oh, I'd quite like to, look at when you could taper. So maybe, increase in tighten monetary conditions. Fed Chair Powell last week said basically they're going to stay low for longer. And I think he's going to say that again, which means you could well see some more dollar weakness as of Wednesday evening after 7:30. So, very interesting times, but I think we're going to see this dollar weakness continue. It makes sense. I mean, Andrew, do you think that as well?
Yeah, I think so. I think it's just double check. I'm not on mute.
Are you fine, Andrew?
No, I think so. I think obviously the concern for us on the options desk is if we break 140, obviously with that being for us being a key psychological level, we will see significant movement. If we open up a new trading range above 140, I think that's a slight concern for us at the moment. We are working quite closely with clients that initially had costed levels at sort of 130, 135. Now it's obviously starting to shift up to 140. So I suppose that's why we're sort of doing what we're doing today. Really, is just to establish what people are trying to sort of where they're trying to mitigate the risk and how they're trying to mitigate that risk. But yeah, I personally think sterling dollar goes higher. I don't necessarily think higher immediately. I think there could be some correction lower without getting into a sort of huge technical trading conversation with Trevor. But yeah, I think if we break 140, I think that could be the issue there personally.
Yeah, absolutely. Yeah, very much so.
Very interesting. Wow. Thank you very much. So next question here. There's a lot of talk of a risk-on, risk-off environment. Could you explain that and what impact that will have for dollar, the yen, and indeed the euro?
Okay, well, this actually comes back from a historical quote. I think it was one of the prime ministers, British prime ministers, Eden, turned around, but please correct me if I'm wrong, and said, you know, sort of his number two said to him, listen, sir, you've got everything sorted out, the economy is going well, you know, what can possibly go wrong? And he said, oh, events, dear boy, events. And that's the problem with that's the difficulty that we have with all of the technical analysis, the fundamental analysis, trying to help clients, etc., is that things happen, such as President Trump in a tweet, or such as President Trump, you know, being impeached, such as something that we don't know, you know, a sort of conflict around the world. These events do change. Now, what do change the markets? Now, what happens when the market is very benign, or is a benign market situation, and you think, oh, actually, it's all lovely and sunny in the world, you know, interest rates are pretty much zero, you know, the economy is coming out, economy is sort of making out of COVID. Yes, we've got relatively difficult times with employment, but we've got a decent chancellor. This is all great stuff. And actually, interest rates are so low. So I'm going to basically, I can invest. So you have a risk on, so you put some risk on. So in that case, you say, listen, I'm going to invest in, let's say, South Africa or Turkey. You know, very interesting that the Turkish lira, you know, collapsed about 25, if not more % last year. And now President Erdogan has said, I'm actually going to play ball now. I'm going to have high interest rates, and I'm going to try and really manage the economy as the market would suggest. Actually, you get 17% return on your Turkish lira. If you bought a Turkish asset, you get 17% in a year. That's good money. That's a good return. So in that case, it's a risk on. It's like, oh, you know what? I've got $100 million, or investors say I've got a large amount of money. Let's put 5% in Turkey. Let's put 10% in China. Let's do something different. It's a risk on. Now then, what happens? All of a sudden, bing, bing, bing. President Biden, I don't know, he gets terminally ill or something happens to the poor man or whatever it is. Okay, Kamala Harris will come in. But that means that the market will go, it's uncertain. We don't know what's happening. So therefore, everyone goes, oh, well, I was going to spend that money in Turkey, but you know what? I'm not going to anymore. I need to have a safe haven. And the dollar and the yen, they're both seen as safe havens. So it's basically saying risk off. I've got no interest. There's too much going on at the moment, so I don't want to invest at the moment. So certainly there are times in President Trump's term, there was certainly risk off situations left, right, and centre. And that's really what happens. Now, what's going to happen if you have a risk off sentiment? You buy dollars, you buy yen. And if you have risk on, then you buy something else. Now, it's really interesting that we saw sort of a risk off situation last week for the year. And in actual fact, euro dollar went up. Now, this is the other problem or the other difficulty, should we say, currencies don't always move as they should do. You know, the pound this morning, we had some reasonable employment data figures this morning, and the pound went down. Fantastic. It should have gone up, but it went down, and now it's sort of trying to recover. So it doesn't always work as you wish it would. And the euro at the moment is very interesting because it's slightly under pressure with what's happening with COVID and the vaccination, as I've explained. But in actual fact, the EU have said they're going to propose that the world, use the euro more. They're trying to get away from this dollar as a reserve currency, because really pretty much the vast majority of goods, products and services, etc., pricing, you can price them in dollars, you know, oil, etc., all commodities, all priced in dollars. So in that case, if you do get a situation whereby the euro is used more often, then you could get this idea of the euro popping higher. But what I would say overall is that, on this sort of, risk off theme, it's a little bit undecided at the moment. So I would suggest that really the euro in the long term may well actually benefit from this dollar weakness. We've said 2 or 3 years of dollar weakness. Yes, I would suggest you can see that, because I think they're starting. They will take time, but the eurozone is a massive trading block, and I would suggest it won't be under the doldrums, forever and a day. So that's how it works on risk off. Oh gosh, let's buy some Turkish lira. Let's not buy some Turkish lira. That's how it works.
So fascinating. This is, yeah, very, very interesting. So I'd like to just wrap the last question up into two, if I could. I know it's difficult because I'm just conscious of time, but I know that Alex is talking to a number of LMForums members across the market about hedging tools, etc.
Sure.
Could you just sort of explain briefly how they're helping the market manage this volatility at the moment?
Yeah, of course. I'll keep this brief, and obviously if we can try and pick it up later if there's time, and that'd be great. Yes, I mean, I suppose every single sort of member or client that we work with will have I suppose different appetite for risk or sort of varying hedging objectives. I suppose what we do here at Eiduks Markets is we work alongside Trevor and Alex to establish those needs. And really what we're looking at the moment is, first and foremost, primary aim would always be to mitigate the risk, to protect clients against any adverse market movements. So the majority of what we're doing at the moment is dollars back into US dollars or Canadian dollars back into sterling. Now, we've tried to sort of, I suppose, diversify in terms of moving away from standard forward contracts over the past couple of years, just purely due to the volatility. Now, whilst forward contracts are great, they provide you with some certainty and some consistency on a month-by-month basis throughout your financial year. So you know what you're accounting at, and you're at or inside or in the money against your sort of costed levels. Therefore, you can account a profit on a yearly basis. They do mean that you're obligated at a fixed rate. And if the market therefore moves in your favor over a period of time, be it sort of 12, 24 months, you're unable to benefit from that market movement. Now, typically, traditionally, what we would look at is vanilla contracts, whereby you would pay a premium up front, and that would therefore fix your rate. And if the market moved in your favor, you'd have no obligation to use the contract itself. The problem is that does have that can have a very significant impact in cash flow. And obviously, with companies at the moment, with the current economic climate we're in, it's not something people are wanting to part way with in terms of cash. So we're trying to build in products that have a premium embedded in them, essentially that would protect you against any sort of adverse market movements, but provide you with a range of flexibility. So if we took, for example, sterling US dollar, and we said, okay, you know that regardless of what happens over the next 12 months, you're protected at 140. So you can sell dollars, buy sterling at 140. You know that you can account at that. And that's just a consistent known worst case rate. The difference where it varies against a forward is that if the market moved between, say, we saw a correction and the market moved between 140 and 130, there'd be no obligation to use that trade. You'd be free to then just sell the currency in the spot market at a far more favorable rate, which obviously then helps from a yield point of view as well. If you are sort of costing at a set rate, you can then benefit by obviously essentially transacting at a better rate than what you've accounted at. I won't go into detail now, purely on the basis that we're probably running out of time slightly, but on the sort of the final point about investment yield in a low yield environment, we do have a number of products that we can use that we do very sort of commonly use that essentially provide the client with an opportunity to achieve a rate that ordinarily wouldn't be available on spot or forward market. So that therefore you're getting a return every month. The market rate itself is probably sort of 3 to 5% off what you're actually achieving in terms of you're in the money on. So that's something that we can go into more detail with each member if they have an interest in understanding more about those products. Due to regulation, I won't sort of blanket a load of information to everyone now, but happy to discuss in more detail later.
Excellent, thank you, Andrew. Yeah, I mean, obviously it's clear there are sort of tools out there that can assist people in this rather unusual environment, and
Sure.
firms will be at different places on that spectrum. But
yeah,
no, that's really helpful. So thank you very much, Trevor and Andrew, for that commentary.